Welcome to this explainer. Okay, think about the last time you bought a cup of coffee, or maybe just picked up a new shirt. You probably just tapped a piece of plastic or scanned a code with your phone, grabbed your stuff, and walked right out. It feels like everyday magic, doesn't it? I mean, it's a completely frictionless experience. But behind that incredibly simple swipe lies a fascinating, super high-speed ecosystem designed to do one very specific thing: evaluate your trustworthiness in a matter of milliseconds.
But, we rarely stop to actually ask ourselves what really happens in those 2 seconds after you swipe your card. To truly wrap our heads around this, we kind of need to shift our perspective. You aren't just making a simple purchase. The moment you tap that card, you are literally initiating a high-speed, unsecured microloan. You're borrowing the bank's money on the promise that you'll pay them back later.
And right there, that brings us to the central conflict of our explainer today: the illusion of free money. Think about it. If you pay your bill on time, your bank essentially gives you up to 45 days of interest-free money. But banks are massive, highly profitable institutions, right? They absolutely aren't running a charity. So how exactly do they profit off of this totally frictionless system while giving us free credit? Let's uncover the mystery. So here's our game plan. We're going to cover the 2-second relay race, explore the business of free money, examine risk and debt traps, look at India's credit boom, dive into the RuPay and UPI revolution, and finally talk about mastering your card.
All right, Section 1, the 2-second relay race. Let's see who's actually in the room.
There are basically 5 distinct players involved in that tiny 2-second window. First up, there's you, the cardholder. Second is the merchant, the shop. Third is the acquirer, that's the merchant's bank that provides the actual card machine. Fourth is the network, like Visa, MasterCard, or RuPay. Think of these as the massive digital highways connecting everyone together. And fifth is the issuer, your bank, the one actually fronting the credit. So when you swipe, the merchant's bank sends a request blazing down that network highway to your bank, basically asking, hey, is this person good for the money? Your bank checks your limit, says yes, sends the approval back down the highway, and boom, the transaction is complete. All of that zipping across the globe in under 2 seconds. Pretty wild.
Moving on to Section 2, the business of free money, how the banks actually profit.
So the first major revenue stream for them is called the merchant discount rate, or MDR. Whenever you buy something for, let's say, $100, the merchant doesn't actually get the full $100. They receive about $98. That remaining roughly 2%, it's a service fee that gets chopped up and split between the merchant's bank, the network, and your issuing bank. So literally just by facilitating the transaction, these financial institutions are taking a tiny invisible slice of global commerce every single time. Now, MDR is a nice, steady baseline for them. But the real money, the absolute massive slice of the pie, that comes from what the industry calls revolvers. These are users who don't pay off their full statement balance. Instead, they carry a balance month to month and accrue incredibly high interest on it. Add to that the annual fees, late payment charges, and those crazy cash advance fees, and you start to see exactly how this whole ecosystem thrives. Your financial discipline is a cost to them, but your delay, that is their major profit.
All right, Section 3, risk and debt traps. Time to look at those high-interest realities.
Let me throw a pretty striking question your way. Why on earth are credit card interest rates so high? Depending on where you live and what your credit score is, you might be seeing APRs, annual percentage rates, soaring up to 30 or even 40% a year. Why is it so absurdly expensive compared to other types of loans? Well, it all comes down to the fundamental difference between secured and unsecured debt. Look at a secured home loan at, say, a 9% APR. It's relatively low because it's secured by actual collateral. If you don't pay up, the bank simply takes your house. Simple as that. But a credit card, it is completely unsecured. If you max out your card and just stop paying, the bank has no physical asset they can easily seize to get their money back. They are taking a massive risk on you, and because of that, you're paying a massive premium purely for the bank's trust. And to put that into perspective, the danger of this high interest is literally staggering. Our source material shares this shocking real-world scenario from Consumer Action. A consumer named Julie got a credit card in college, right? She runs up a balance of $2,000 at a 26.99% APR. If she only pays the $50 minimum amount due each month, guess how long it's going to take her to be rid of that debt? 62 years. No way, right? But it's true. That minimum amount due is a psychological trap designed to keep you paying interest for a lifetime without actually making a dent in your principal balance.
Next up, Section 4, India's credit boom. Let's look at a massive case study.
India's outstanding credit card receivables are on this explosive upward trajectory right now.
They've escalated from just 0.57 trillion Indian rupees in 2017 to a staggering 2.57 trillion by March 2024. This massive surge is being driven by aggressive digital lending, changing consumer preferences, and a growing middle class that is super eager to leverage unsecured retail credit.
To really wrap our heads around the sheer scale of this market, get this. As of mid-2025, there were over 111 million active credit cards circulating in India. And while that sounds absolutely huge, when you consider India's population, it still represents an immense runway for growth, mostly because credit in the country has historically been pretty informal. But, with rapid expansion comes real-world stress. State-wise delinquency rates, meaning payments that are overdue by more than 90 days, show that major urban hubs are the ones really driving defaults. Maharashtra is sitting at 2.8%, followed closely by Delhi and Karnataka. High rents, stagnant wages, inflation, and overextended urban professionals chasing lifestyles on EMI, it's all pushing up these default rates. And get this, Gen Z alone makes up 35% of these defaulters. That is huge.
Which brings us to Section 5, the RuPay and UPI revolution, the big technological shift.
This is a real game changer. Remarkably, nearly 40% of all credit card transactions by volume in India are now linked directly to the UPI network. That is a massive paradigm shift. Historically, credit cards were mostly for, big-ticket purchases online or at large retail stores.
But integrating credit cards with UPI, it has completely changed the game. It's basically fusing digital credit lines with those everyday Kirana store QR codes. Thanks to the homegrown GroupPay network and innovative fintech platforms like Kiwi, consumers can now just use their credit cards to pay for a simple cup of tea or local groceries via a quick UPI scan. It's taken everyday spontaneous spending and turned it into completely frictionless credit transactions, practically pushing debit card usage to the side. Finally, Section 6, Mastering Your Credit Card, Your Rules of Engagement.
Okay, here are your strict rules of engagement if you want to avoid the debt trap and actually reap the rewards. Rule 1, always, and I mean always, pay the full statement balance by the due date so you avoid interest entirely. Rule 2, completely ignore the minimum amount due on your statement. Like we said, it's a trap designed to turn you into a revolver. Rule 3, keep your credit utilization low to protect your credit score. And Rule 4, never ever use cash advances. They come with exorbitant fees, and the interest starts accruing the exact second you withdraw the cash. There is zero grace period.
So wrapping up this explainer today, I really want to leave you with a provocative question to chew on. Ultimately, who is really in control of the swipe? Is it you consciously managing a 45-day interest-free loan? Or is the frictionless nature of the technology actually managing you, quietly nudging you toward a lifetime of 40% interest? This ecosystem is incredibly powerful, and yeah, it's super convenient, but mastering it requires knowing exactly who is profiting when you tap that card. Thanks for joining me on this explainer, and hey, stay financially vigilant out there.
Welcome.